Importance of management. Management is the single most important thing in a company. But for an outsider to know great management versus good management versus terrific management versus average management, tough to do. Tough to do. Because you only get an hour at people, sometimes a half an hour. And how do you know what decisions they didn't make? A lot of great companies have been made because the company didn't make an acquisition. They didn't get rid of the division. They don't put in the annual report, we didn't get rid of the tubing division. You know, you don't hear about that. Somebody said, made a brilliant decision, we're going to hold on to that thing, we're going to fix it, and it's doing great. Now, they might be doing great because some management 8 years ago did it right, or some did something right 5 years ago. That person isn't there anymore. Or they didn't make any acquisitions, or they expanded at the right time. So knowing what management, what they can add to it, it's the single most important thing, very hard to measure. I've always said, I'd like to have a company any fool can run, because eventually one will. And you really want to do that. When I bought Toys R Us, they had the formula right. Any 4 people in this room and me could have run Toys R Us.
What's the biggest mistake you ever made? Have you made it?
Coming here tonight.
Oh my God, have I prepared so hard? No.
You know, I've been very fortunate. If you're talking about at work, I've never really screwed up a lot. We went through tumultuous times. We stuck to our discipline. We've made mistakes. They often are where we underestimated the leverage in the situation. We didn't think it was that big a deal, but leverage can magnify your returns, but also magnifies your losses. Getting in bed with bad people. We've had investments where...
See, these are interesting points, getting in bed with bad people.
Yeah.
How does that happen, and how do you avoid that?
So a lot of stocks are cheap for a reason, and often a value investor will figure out the reason because everybody else has gotten sick of a management raping and pillaging a company, overpaying themselves, deploying capital poorly, taking advantage of the shareholders with free stock or huge options awards, or hiring their brother-in-law. So there are stocks that have been perennially undervalued because they're run by somebody who fits that profile. A novice value investor will come along and say, well, that looks awfully cheap. And Graham and Dodd didn't really place the quality of management as high as they might have. And so good managements add value. Good managements have lots of levers they can pull. They can buy back stock when it's undervalued. They can use the stock as currency when it's overvalued. Bad managements will think only about themselves first. And so those are early lessons, but profound lessons that I learned them well.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.
Now, I was never very good at judging people's character as such. If you go to talk to a management, they may be charming people. They may be very nice, but you don't know anything about them. So I found it really was better for me to look at the numbers than to try to look at the people themselves. One of the reasons I don't really talk to managements is managements have a way of presenting the facts the way they want you to see them. And I'm not a terribly good judge of people. Warren Buffett really is a remarkable man in that respect. He's very, very good about deciding who is good and who isn't. I like to think that that's why he likes me, but...
I was wondering if there is anything subjective in yours and Mr. Munger's assessment of whether or not you like someone, and how it is that you determine whether or not you like the lord of the castle.
Mm-hmm. Well, I don't know, Charlie, do you want to answer that second part?
Well, we spoke about agency costs, and there are two different kinds of agency costs. One, the guy favors himself at the expense of the shareholders, and the other is he does foolish things, or he's not trying to favor himself, he just is foolish by nature. Either way, it's very costly to you as the shareholder. So you have to judge those two aspects of human character, and they're terribly important. And on the other hand, there are some good businesses so good that they'll easily stand a lot of folly. in the managerial suite. And much as we like perfect people, I don't think we've always invested with them.
But generally, we like people who are candid. We can usually tell when somebody's dancing around something, or when the reports are essentially a little dishonest or biased or something. And it's just a lot easier to operate with people that are candid. And we like people that are smart. You know, that I don't mean geniuses, and we like people who are focused on the business. It's not real complicated, but we generally, you know, there may be a whole bunch of people in the middle that we don't really have any feeling on one way or the other, and then we see some that we know we don't want to be associated with, and some that we know we very much enjoy being associated with.
Averaged out, we've been very fortunate.
Very lucky.
My question is concerning that what you were just describing as smelling. And I mean, you told us in former shareholder meetings, if management loves money, do not invest. If they love what they do, preferably if they come tap dancing to the office every day, and all other things are right, then invest. That resonated to me very good with the biblical truth that not money itself, but love for money is the root of all evil. And the principle that once made Prussia the largest of all German kingdoms, namely the ethos of doing a job for its own sake. When you tell us in this year's report that you buy a company after talking to the owners for no more than 90 minutes, I'm wondering what kind of, is it the wisdom of experience, just like you described it, or do you do more background work before talking to the owners for 90 minutes? What's the process like? Do you do background checks, or do you talk to competitors? Do the other people in headquarters do that work for you? How does this whole thing work?
Well, it's a very good question, and all of the things you suggest might well make sense. I mean, talking to competitors, talking to ex-employees, talking to current employees, talking to customers, talking to suppliers, all of those things Phil Fisher laid out in a book over 40 years ago, and we have done a fair amount of that over the years. But
secondly, you talk about good management with corporations and that you try and buy companies with good management. I feel that I have about as much chance of meeting good managers other than yourself as I do bringing Richard Nixon back to life. How do I, as an average investor, find out what good management is?
Well, I think you judge management by two yardsticks. One is how well they run the business, and I think you can learn a lot about that by reading about both what they've accomplished and what their competitors have accomplished, and seeing how they have allocated capital over time. You have to have some understanding of the hand they were dealt when they themselves got a chance to play the hand. But if you understand something about the business they're in, and you can't understand it in every business, but you can find industries or companies where you can't understand it, then you simply want to look at how well they have been doing in playing the hand essentially that's been dealt with them. And then the second thing you want to figure out is how well that they treat their owners. And I think you can get a handle on that oftentimes. A lot of times you can't. I mean, there are many companies that obviously fall in somewhere in that 20th to 80th percentile, and it's a little hard to pick out where they do fall. But I think you can usually figure out. I mean, it's not hard to figure out that, say, Bill Gates or Tom Murphy, or Don Keogh, or people like that are really outstanding managers, and it's hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum too. It's interesting how often the ones that, in my view, are the poor managers also turn out to be the ones that really don't think that much about the shareholders too. The two often go hand in hand. But I think reading of reports, reading of competitors' reports, I think you'll get a fix on that in some cases. You don't have to, you don't have to make 100 correct judgments in this business or 50 correct judgments. You only have to make a few. And that's all we try to do. And generally speaking, the conclusions I've come to about managers have really come about the same way you could make yours. I mean, they've come about by reading reports rather than any intimate personal knowledge or knowing them personally at all. Read the proxy statements, see what they think of, see how they treat themselves versus how they treat the shareholders, and look at what they have accomplished considering what the hand was that they were dealt when they took over, compared to what is going on in the industry. And I think you can figure it out sometimes. You don't have to figure it out very often. Charlie?
Nothing to add.
Tell me what you look for in management.
You want to find management that, of course, is terrific at managing the business, and presumably they've demonstrated that by the time we get involved. We're very interested in how they think about lots of things. We ask them often, how do you measure your success at this company? By what means? By what? And so we listen to what they have to say and make our own judgments about that. And
what are the kinds of answers that
well,
you like?
Sometimes you get answers such as, well, if the stock price goes up, and sometimes you find CEOs that have screens on their desk. They're watching the stock price all day long, and that's not a characteristic that we find particularly attractive.
Because you don't care about the short-term
right,
stock performance?
And I would say our quick judgment would be their eyes on the wrong thing. That's our own parochial view, and we're interested in hearing how they discuss the reinvestment of the free cash flow they generate, and how they discuss the arrangement of their balance sheet, and whether they use debt capital and so on, and how much they use, why they, all of these kinds of issues are very important in helping us with our judgment.
Take for tangent for a second. Jack Welch, Lee Iacocca, what is it they have? What you would go around and do a self-analysis of companies, right. and you would look for things that you could identify with, right. and know that they had the potential to grow, right. and they had a culture, right. to grow, and they had, right. A plan to grow. What do great managers do?
Well, there's two types. You have Fred Smith, who comes up with an idea, right. called Federal Express. Right. Then he had to grow it, and that's really tricky. Sometimes, right. people can just do the idea part. He did all the parts. Right. And then there's Lee Iacocca, had to turn around at trouble with Chrysler, and even more challenging, a giant company like General Electric, to make something good better. I mean, right. that's really hard. So all these people basically were problem solvers, and they had to manage people. And one of the things that surprises people, they don't even understand the definition of management. It's getting things done through others. It's a lot easier to do something yourself. Yeah. If you have somebody else do it, and lots of people, obviously you're managing people, and sometimes you have to encourage them, sometimes you have to push them a little hard.
Right. Inspire,
people are different.
motivate,
it's hard.
encourage.
But you have to understand what they want. You have to work with them. You have to explain yourself. You have to set goals. And you have to be a leader yourself, and you have to put a lot of effort into it. And you have to make mistakes. And there's a real amazing difference between being persistent and being stubborn. And I think great leaders to say, this is it.
Persistence is good, stubborn's bad.
Persistence is terrific. Stubborn's terrible.
But do great managers listen?
Yes, they do. Absolutely. Yeah. Categorically.
I've come to know and believe that listening is a principal, essential quality.
And sometimes managers get so high up, the people around them aren't giving them ideas. They're just chill and filtering everything else. Yeah. They don't have a chance to listen.
And the best manager will make sure they do hear the best thing.
And they go out on their own, do their own research, independent of the people around them.
Yeah. Warren and Charlie, you spend a lot of time evaluating the management quality and integrity of the companies that you may invest in. In my current job, I do not have the opportunity to do that. As I read through annual reports and financial statements, what do you suggest I focus on to help me to determine the quality and integrity of management?
Well, we spent many years, and we bought many things. I mean, without meeting managements at all, having any entree to them, the stocks, the $5 billion of stocks that we may have bought in the first quarter, most of those were companies I've never met the management, never talked to them. We read a lot. We read annual reports. We read about competitors. We read about the industries they're in.
In terms of sizing up managements, obviously, if we're going to buy the whole business, that's a different question. Because we're going to buy it, be in bed with them, they're going to run them, and we care very much about whether they're going to behave in the future as they have in the past once we own the business. And we've had very good luck on that. But in terms of marketable securities, we read the reports. Now, Charlie and I were just talking about one the other day where we read an annual report of a large oil company, and the company, 100 pages, public relations people, lots of pictures, spent a fortune on it, and you can't find in that report what their finding cost per MCF or per barrel of oil was last year. That's the most important figure in an oil and gas company over a period of years, but every year it counts. The fact it wouldn't even be discussed, the reason it wasn't discussed, it was absolutely terrible, but the fact it wouldn't even be discussed, and to the extent it was touched on, it was done in a dishonest manner. When we read things where we basically are getting dishonest messages from the management, it makes a difference to us. Like I say, in marketable securities, we can solve that by selling the stock, and it's not the same thing as buying the entire business. But I think you can learn a lot by reading the annual letters. I mean, for one thing, if it's clearly the product of some investor relations department or outside consultant or something of the sort, that tells you something about the individual. If he's not willing to talk once a year through a few pages to the people who gave him their money to invest, I mean, I've got some questions about people like that. So I like that feeling that I'm hearing directly from somebody who regards me as a partner, and you may not get it all the way, but when I get it 0% of the way, I don't like it. We've still bought into some, in marketable securities, we've bought into some extremely good businesses where we thought they were run by people we didn't really like very well. We didn't feel they could screw them up. Charlie?
Yeah, I think that's exactly right. That there are two things, the quality of the business and the quality of the management. And if the business is good enough, it will carry a lousy manager. And the converse case, where a really good manager gets in a really lousy business, you'll ordinarily have a very imperfect record. In other words, it's a rare person that can take over a textile business totally doomed, which was what Warren did in his youthful folly, and turn it into what's happened here. You should not be looking for other Warrens on the theory they're under every bush.
I figured it out in 20 years, though. I'll have to say that for myself. 20 years, and I finally figured out I was in the wrong business. But there are businesses. If you gave me first draft pick of all the CEOs in America and said it's your job to run Ford Motor now, or pick a company that's in a terribly tough business, I wouldn't do it. I mean, it's just too tough. They may get it solved, if they get cooperation from unions and a whole bunch of things, but it will not be solely in the control of the CEO who has that job. He is dependent on too many good things happening outside to say that he alone can get the job, even if he's the best in the world.
So you find out these people want to help you. If you go visit them, even on the phone. Yeah. And I remember calling one company up, and you get to know a person's personality. Some people are very optimistic, they're very upbeat. Some people are kind of very conservative. And his tone just was not as optimistic. I found out later, I almost sold my entire position. You get that feeling. Yeah. I called him a week later. I said, you were just down. He says, yeah, my brother was in a traffic accident about a half an hour before he called, and I didn't know whether he was going to make it or not. Yeah. I almost sold my entire position because of an accident.
But you had another question to ask. Yeah.
I called back and I said, gee,
Yeah. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.